Hi, this is Tim Obendorf with Stewart Advisors, and today I'd like to talk about a little used tool that we like to recommend for our clients to fund their medical expenses. So we're talking about a health savings account, and a health savings account is a tax advantage account that lets you save funds pre-tax and accumulate those funds to pay for future qualified medical expenses. So the account belongs to you, it's yours whether you leave your employer or you retire. And you don't pay taxes on the money that you contribute or take out as long as you use it for qualified medical expenses. And many health savings accounts allow you to invest the funds like a 401k or brokerage account. In order to be able to contribute to an account, you have to be covered by a high deductible medical plan. And you can't be covered by a second plan. So you can't be under a high deductible plan on your employer and then be also covered by your spouse's plan that's not high deductible at another employer. Also, you can't make contributions to an HSA if you're enrolled in Medicare. You can have the account still when you're under Medicare, but you can't make additional contributions. And finally, you can't be a dependent claimed on somebody else's tax return. So if you meet all these qualifications, you're able to make these contributions that are outlined here. So for an individual, $3,650 a year, with a catch-up contribution if you're 55 and older of $1,000, or the family contribution of $7,300 per year with the catch-up contribution of $1,000. Now, the way we like to recommend using an HSA is to contribute the maximum amount each year, and then along the way, pay your medical expenses out of pocket. We recommend that you choose an HSA that has an investment option, so the amount that you put in, you can invest in stocks and bonds, just like you could your 401k. Along the way, when you incur medical expenses, you want to make sure that you document those medical expenses. So that would be keeping receipts or explanation of benefits from hospitals or doctors. And you get a current year deduction for the funds that you put into the account. Those funds grow tax-free. And then as long as you use them to cover qualified expenses, any expenses that are incurred from the date the HSA is established can be reimbursed tax-free. And so you get the tax deduction up front, you get the tax-free growth, and you get the tax-free withdrawal. It's better than an IRA or 401k from a tax standpoint. I want to walk you through an example of a couple that starts contributing to an HSA from age 55 until they're eligible for Medicare at age 65. So during that 10-year period, they're going to contribute the maximum amount of $8,300, and they're going to pay their medical expenses out of pocket. And for this example, they have $50,000 of medical expenses that they incur in those 10 years, and they keep the records on those medical expenses. The funds are invested and they earn 8% a year, so that will accumulate and grow to $120,000 by the time they're age 65. Now, once they're in retirement, they can tap that account to pay for current medical expenses, including long-term care and long-term care insurance and their Medicare premiums. Also, if they have a big expense, an unforeseen expense where this is the most efficient way to fund it, they can submit up to that $50,000 in medical expense receipts that they've kept track of and withdraw the funds tax-free. To give you an idea of how much they save by doing this, their tax deduction that they get during their pre-retirement years is their tax rate times the $83,000 that they've contributed. So they're in a high tax rate between state and federal. They're at a 35% marginal rate. So that would be a savings of over $29,000 during the pre-retirement years. And then the growth on those funds, so the growth from $83,000 to $120,000 is not taxed and can be used to reimburse for any medical expenses. So that that growth at 35% saves them another $12,000, almost $13,000 of tax in retirement. Now, if we look at all the benefits, the first one is that by choosing a high deductible medical plan, you're probably going to pay lower premiums on your medical insurance than you would with a lower deductible plan. A lot of people don't choose a high deductible plan because they're worried about how to cover that deductible. But this HSA account allows you to build up a nest egg to be able to cover those unforeseen high deductibles that you might be out of pocket for. Secondly, we've already talked about the tax deduction for the contributions. And in addition, not only do you get an income tax deduction, but if the contribution is made by your employer, or if you're in a cafeteria plan and make those contributions through that cafeteria plan, those contributions are not subject to payroll tax. So it's even in addition to your income tax savings. Those investments grow tax-free, and then they can be used tax-free for qualified medical expenses. As I mentioned, this can be a safety net for large medical bills or even some other large bills, as long as you have medical receipts, qualified medical receipts to submit for reimbursement. So that can give you some peace of mind, beyond just the tax savings that you get with this type of structure. The other thing that we've found is that HSA owners tend to scrutinize their medical bills and shop for lower cost treatment. So we know that there's a wide range of costs for things like MRIs. And if you're paying for them out of your own funds, and since the HSA is your funds, you're going to be much more likely to scrutinize and shop around. And you might save 50% or more on certain costs of medical treatment. Another benefit is that unlike flexible spending accounts, the HSA is not a use it or lose it type of situation. So these funds are available year after year. Funds you put in today can be used 20 or 30 years in the future. With a flexible spending account, you may have experience with that, where there's a time period each year where you have to use the funds or you lose them. In addition, some employers will make contributions to your HSA, so it may not be something that is all funded by your own cash flow. And then finally, the HSA effectively makes medical expenses deductible even if you don't meet the threshold to itemize those deductions. So not only is there an overall itemized deduction threshold, but there's a threshold to include medical expenses on your itemized deductions. Because you can do small dollars and keep the receipts and reimburse yourself for those, it makes a lot of medical expenses deductible that wouldn't have been otherwise. Now, I hope this has been helpful. I'm sure you have some other questions, so we'd love to hear from you. You can follow up with myself or my partner, Mike, and we'd be happy to answer any questions about HSAs or other financial planning topics. Thanks again. Bye-bye.